Hello, I'm Kevin Flynn, and welcome to another edition of Avalon's Market Minute. It's June 23rd, 2013. You probably noticed that stock prices came under pressure again last week after Fed Chairman Ben Bernanke talked about the end of quantitative easing, one part of the Federal Reserve Bank's easy money policy. I thought that Bernanke might downplay such talk after the market's strong reaction last month, and apparently the markets thought so too, because they rallied strongly into the Fed meeting last week. But he zigged instead of zagging, and there's now some fear in the air in the stock market. The rush for the exits was so strong last week that the selling on Wednesday and Thursday overpowered what would normally have been an options-fueled rally in the latter half of the week. The fall in bond prices and the serious fall in asset prices for all emerging markets has led to a lot of trades needing to be unwound in a hurry. Municipal bonds, of all things, are getting crushed, partly by forced selling and partly by retail panic. The Muni Bond ETF is down almost 15% from the middle of December, with most of the damage coming in the last month, and that doesn't really make a lot of sense. One observation I have made that has stayed true to form is that June is a volatile month, one that often takes a steep dip. As we approach quarter end on Friday, we should see more volatility. The economic calendar is heavy this week, and that should add some excitement to the mix. Good reports in areas such as housing or durable goods might stem the tide, or disappointments could turn the selling into a rout. On a short-term basis, stock indices and bond prices are quite oversold, so it wouldn't be surprising to see the week end up sideways after lots of back-and-forth action. But in my columns on the Seeking Alpha website, I've been advising people to stay on the sideline the last 4 weeks, and that advice holds true today. Prices are oversold, but they aren't so beat up that traders are ready to jump in at the chance of a reversal quite yet. It's been a sentiment-driven market this year, and sentiment is currently weak. It's also hard to predict from day to day. Soothing words from the Fed might turn things right around, or there could be a bit of news from somewhere else that accentuates the feeling of panic. Remember, markets usually overshoot in both directions. So I wouldn't go leaping back into equities or bonds quite yet, although taxable accounts should be taking a look at municipal bond funds. There will be a counter rally soon, but we could lose another couple of percent first. So enjoy the summer weather and let the market find its footing without you. I'm Kevin Flynn, and thank you for listening to Avalon's Market Minute.